Hey traders, this is Blake Morrow with Traders Summit, and I have Jim Welsh with us from Macro Tides. Jim, what a crazy week. You know, we're ending the week on a weak note.
Yeah,
Stocks are rolling over. We had some very weak PMI data that came out. So here we are. I mean,
yeah,
we got,
yeah,
market data is weak and stocks aren't liking it. I mean, it was really weak,
yeah,
as I say.
yeah. Well, again, I think no one really should be surprised because we're seeing globally central banks all over the world are raising rates and in many places raising aggressively. Financial liquidity is, receding. So, and the strength in the dollar, fallout in other currencies is playing a role. And then lastly, obviously, Europe. The increase in energy costs, the prospects of a long, dark, cold winter has crushed consumer confidence in a number of the European countries. So you got a lot of things coming together, Blake, that just spell more weakness in coming months.
Well, with weakness, and I know we're going to talk about that. Well, let's just talk about it right now. Next
Yeah,
week we have the FOMC. The day after that, we have advanced GDP numbers. I'm assuming that the Fed's going to have those advanced numbers, in
yeah.
advance of us getting the
Advanced for
advanced
them, yeah.
numbers. Right, it's advanced numbers. Anyway, I'm assuming that that could show that we're in a technical recession, but you've been pretty much a staunch no recession in 2022. That's going to be a
Right.
2023 thing.
Yep.
So what happens next week if we get a technical recession, or does that just
Yeah.
not matter?
Well, no, it matters because it creates perceptions. The headlines will be talking about technically the U.S. economy is in a recession, and again, the reason why I am not in that camp just because in the first quarter GDP was negative by 1.6%, but they subtracted over 3% from domestic GDP because of imports fulfilling final demand, which actually grew 3.7% in the first quarter. Business investment was up 9%. So the outfit that determines when a recession starts, I mean, if we go into recession, they will not include the first quarter, is my point. So it doesn't mean we're not going to have a recession or any of that. I have just said that the level of consumer savings, job growth, wage growth, all suggest that it's a 2023 story, not a 2022 story. But you're absolutely right. A lot of attention will be created if we get a negative GDP on that first estimate. And it's going to probably be close. I mean, there's outfits that are looking for 1% growth. The GDP now figure out of the Atlanta Fed, last I looked, was at a minus 1.6. It's going to be close. But again, I just take the numbers and analyze them and try to play it straight as opposed to just go by the headline.
Yeah, makes sense. Okay, so well, let's talk about the FOMC. So next week, we have the Fed. Are you expecting a 3/4 point raise,
Yep,
a
I've
full
been
point?
consistent.
Oh,
Yeah.
okay, 3/4 point. Okay.
Oh yeah, no, I mean 3 weeks ago when people were starting to say, hey, commodity prices are breaking down and we've got some weak data, maybe they'll only do 50. And then we had, the CPI and the PPI reports showed inflation really hot. Oh, we're going to get 100. And all the way through 75. They've telegraphed 75. And by going 75, they'll get it to 2.25, 2.5. Powell's talked about, and other FOMC members, the need to get the funds rate to near neutral. Powell says it's 250 as expeditiously as possible. So to me, they've just been on a steady path. The key thing, I think, Blake, is that in his comments and everything else, because you had a 9 handle on the CPI, and he has actually said he's paying more attention to the headline because most consumers pay attention to the headline, because it affects them directly when they go to the grocery store, gas station, and so forth. But that also plays a role in affecting inflation expectations. And what the Fed doesn't want to see is inflation expectations start to take hold where people are buying more stuff now because they think prices are going to go up, demanding more wage increases, which will obviously bleed through to prices later on. So I think what that means with that 9 handle is Powell and the FOMC in coming weeks are going to talk pretty tough. The need to get inflation down. They're going to be resolute. And even it means putting the economy at risk of going into recession. So I think the talk from Powell after the meeting and in the weeks following is going to be, hey, we're serious about what we're going to do, and we're going to bring inflation down. I think that's negative news for the equity market, and it's probably positive news for treasury bonds. And that's been my take for weeks.
Well, you say that, and you have been saying that, and I'm gonna pull up your TLT chart because that was the first chart that you brought today. So let's take a quick look at TLT. So what are you expecting? Higher bond prices, lower yields? I mean, that's kind of what we're getting.
Yep. I mean, that arrow you can see mid-June, that's when I said it's time to buy TLT. I thought potentially the decline from 155 to 108 was a 5-wave decline that had just finished, and that we were going to see bond yields come down, treasury bond prices rally as we got more data showing the economy was in fact slowing. And so far it's been, very choppy, but you can see clearly the highs are higher, the lows are lower, or pardon me, lows are also higher. I recommended TLT was around 110.25 in June 16th, got stopped on 40% at 116.10. And to me, raising the stop to 115 or so, I think makes sense. I think the odds favor that we're going to see bond yields continue to work their way lower. And, I think Powell's comments next week are going to play a role. That 125 target is nothing more than the 382 retracement, Blake, of the decline from 155 to 108, 47 points, 382 gets you up to around the 125, 126. So, to me, this is what's happening. And, again, the data that you noted at the beginning is supportive of bond yields coming down.
Yeah, and we're going to talk about other assets, but first you wanted to discuss the S&P. So we rallied above 4,000 today. We got about 4,010, 15 if you're using a CFD or futures or whatever. We're back below 4,000 right now. Where to from here?
Okay. Again, in mid-June, I thought we were at a low that we would see a rally. S&P rallied 300 points. Then I was looking for a pullback. We got the pullback. And a couple of weeks ago, when we did our call, I said, as long as we hold 37.39, the S&P still has the potential to, at a minimum, rally above 39.46 and potentially to 4,031.
So we went down low enough just to stop everybody out, right?
Yeah, the intraday stopped it, but it closed above 37.39.
Yep.
And for me, it meant that the decline from 39.46 was an A down, B up to 39.18, and 37.22 was wave C of a B wave. And then we were going to get the C wave that would at least, as I said, 39.46. The equality target is 4,031. If you look at the panel below the S&P, you can see we're now, we were very oversold a week ago. We're now overbought. I think we're going to have a pullback. And if this analysis of an ABC off the low of mid-June at 36.37 is correct, there is the potential we're going to go down and retest that low over the next few weeks. And again, fundamentally, tough talk from the Fed. Earnings haven't yet been fully, I think, cut to reflect the slowing that we're going to see. In the next 3 weeks, we're going to get a ton of earnings reports. And then lastly, as we saw today, economic data is not going to show strength. It's going to show more weakness. So overall headwinds for the S&P.
Well, what would make you wrong? What drives the market to 4,100 or 4,200 in the S&P following the Fed? What's the Fed got to do there to make that happen?
They would have to offer some window where, a comment like, well, we're at neutral, something that shows that they're
a pivot
backing away from 75 basis point increases. Right now, 75 bips is on the table for the September 21 meeting. I just think that 9 handle on the CPI precludes the Fed in the short run from offering any window of hope that they're going to downshift. Now, personally, I think there is a probability that as we get into late August, early September, we will start to see some talk that suggests that they're going to debate at the September 21 meeting whether to go 75 or 50. And that's when I expect a very significant rally in the market that will take us up towards the 4,400 level. And think about it, the S&P went from 4,800 to call it 3,600, make the numbers simple. 1,200 points, 618 retracement is 740 points, something like that.
Yeah.
So from the low at 3,600, you add 740 some points, and voila, you're almost at 4,400. So I think that the S&P will get to 4,400 probably in October, but I just think there's another dip coming. And it's possible, Blake, that this rally from 36.37 is an ABC up to the high we saw today, or maybe a modest new higher high next week early. And then we get a three-wave decline and another rally, that will be comparable to this rally. So in other words, it's just a bigger ABC. Three waves up to the high we're forming now for a bigger wave A, a pullback for a bigger B wave, and then a C wave rally. So we don't know the path right now. At least I don't. I just think the odds are, given the headwinds the S&P is going to face in the next few weeks, there's a pullback coming. And if you take out 37.22, hey, it's a short distance to test the lows at 36.37.
All right, fair enough. Well, let's. You also brought gold. Now, gold has had a really interesting move this week. We dropped to 1680. That 1670, 1680. This is really critical support from back here in 2021. Those spike lows got tested. Here we are, but this is the COT data. So how are you reading it?
Well, again, I look at it as a sentiment indicator, where large speculators, when they get really super bullish, they've obviously been going long, which drives prices up. And then as prices go down, which we've seen since March, they start to get less positive and they liquidate. And so what we can see is, from a positioning standpoint, large speculators have their lowest long position going back 3 years. So that to me is positive. The pattern that we've discussed in recent weeks was that the high in August 2020 at 2070 was the pullback to that where the letter A is at 1680, whatever the number was. That was wave A. You can see pullback up to the high in March for B. And my expectation was that we were nearing the end of a wave C, and that the S&P the gold would drop under the low that we saw last week at 1798. And so I think we've completed potentially a big ABC correction from the high at 2070. At a minimum, I think, and if we can go to the next chart, because we focus in a little bit closer on the near-term trading, what we see is at the low this week, Blake, the S&P, or I keep saying that, gold touched the trend line, which goes back some time. I think we completed the ABC. Obviously, the bottom panel shows the RSI on a weekly basis, pretty oversold. The rebound off of yesterday's low was a really good first start. And so I've been kind of scaling in, as we said, 33% when gold was trading at 1765. I said buy another third if it dips under 1720, and that's when it got down to 1698. And then another third, which got triggered yesterday on a dip below 1698. So as I said, I think at a minimum, gold's going to rally towards 1850. And there's an outside chance, if I'm right about monetary policy, where the Fed dials back, they're not going to stop raising rates. I just think there's, at some point in time, they're going to lower the magnitude. It's like an airplane. You're flying at 33,000 feet. The pilot says, hey, we're approaching our destination, going to begin our descent. Well, the rate of descent from 33,000 feet to 10,000 is a lot faster than from 3,000 to the ground. They want to hit a soft landing, right? And I think that means the Fed at some point in time is going to go from 75 to 50, and then at some point in time, potentially 25. But the way the markets will react, Blake, to the Fed is downshifting. I just think that the dollar weakens, which we'll talk about. Gold gets a nice rally. Bonds may actually kind of top on that news, which is always counterproductive or counterintuitive. And the S&P can have that big retracement rally we've already talked about. So again, I just think buying gold at 1,700 was a good idea. All right.
Well, and then now we have the dollar. So what do we do with the dollar index here? Looks like we might have peaked this week. What are your thoughts?
Okay. The dollar index, you can see the short-term trend line from late May. It's still above that. The high off that late May low, wave one at 105.75. If there's going to be one more new high on the dollar index, it shouldn't overlap 105.75. So to me, until you break that trend line, you overlap 105.75, there is still the potential that there's going to be one more new high in the dollar index. But I'm in the camp and have been like, all right, we're coming near a high here. It just, technically the chart pattern, higher highs, higher lows. I mean, this is where technical analysis is, to me, indispensable. Because if you were shorting, expecting the dollar to go down, whatever, hey, this tells you not to be doing that. And I think it's still too early yet to go short the dollar. But my expectation is there is a pullback coming in the dollar index. And again, it ties in with the idea that the FOMC at some point in time, I think late August, early September, will communicate that, yeah, they're seriously going to be thinking, or 50 basis points is on the table rather than 75, that there will be a discussion. They will communicate that.
Well, the dollar would sell off in that event then.
Yes.
Okay.
So,
but oh, go ahead.
No, you go ahead, buddy.
Well, I was just going to say, well, we had the ECB this week, and the euro, as you point, this is, such a big component of the dollar index. The euro is really struggling down here, Jim.
Yeah.
And how's the dollar supposed to rally if it's lacking euro participation? It's gonna be very difficult.
Well, here's the thing.
I'm sorry. How's the dollar supposed to sell off with the euro underperforming? That's what I meant to say.
It's Friday.
It is Friday. Sorry.
I knew what you meant.
I know. It's Friday, and I'm like, oh, God. Okay.
I kept calling gold the S&P. So
right. There you go. So here we got the euro. What's your view on the euro? Because like I said, the dollar's going to have a hard time pulling back if the euro can't get out of its own way.
That's right. Okay. So look at the euro chart. You can see that you got 3 waves down from the high in late June. 1, 2, 3 to the low a week ago, right? This bounce on the news sure looks like a wave 4. So unless it overlaps the low of wave 1, which is 103.59, the door is open for the euro to go down one more time and make a lower low. And if it does, I think you'll see some nice RSI divergences. Same thing, positive divergences. The dollar, if it makes a modest new high, will have negative RSI divergences. The table will be set. And so to me, if the euro does that, I think it's setting up a great buying opportunity.
So you want to be a buyer on the euro below 99.52 if possible.
Yep.
All right.
Down there because it'll complete, I think, the pattern. And as we said, I think the dollar is going to have a pullback and the euro should really benefit. It's 57% of the dollar index. So you're right. You're not going to get the dollar pulling back unless the euro is rallying.
My colleagues over at Forex Analytics believe that the ECB will continue to raise rates and they're going to continue to stay hawkish and keep raising rates at a 0.5 point clip. And I think that would definitely catch the market a little wrong-footed because I don't think most people are in that view.
Well, and think about the combination, whether it's 25 or 50 bips on the ECB and the Fed dials back a little bit, you're talking, pretty strong reaction because the negativity towards the euro is really extreme, Now, just as an observation, the ECB raised interest rates 50 basis points. They went from minus 0.5 to 0. That's the weird world that we've been into that you can call going from below 0 to 0 an interest rate increase. I mean, it is, of course, but it's just bizarre. It
is.
So anyway.
Well, Jim, I want to thank you for being with us every week, kind of walking us through the markets and giving your thoughts because, look, as traders, we all know you're not or we're not going to be right all the time. We take losses, we have gains, you make great calls, And more times than not, you're on the right side. So as a trader, how do I learn more about what you do at Macro Tides?
Thank you. Well, macrotides.com. You can get information there. And if you can also request a sample letter, recent letter, and I'm happy to send a recent weekly technical review or the monthly Macro Tides out to anyone who would like additional information.
Well, Jim, I want to thank you for being with us each and every week. And if you appreciate what Jim does, make sure you give him a thumbs up on YouTube, subscribe to the channel so you don't miss any of this exclusive content that we do. Jim, have a great weekend, and thanks for joining us once again.
Hey, you too, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.